predictably no matter the market conditions, especially for growing your business. Look no further than our guest this week, Sarry Ibrahim. Sarry is a financial specialist and private money lender who has been helping business owners, real estate investors, and full-time employees build secure wealth for over 160 years with his financial strategy. He is a member of Bank on Yourself organization that helps with financial planning and investing. He has a wealth of experience having worked for major companies like Allstate, Blue Cross Blue Shield, Humana, before founding his own financial services firm, Financial Asset Protection, where he solely focuses on the bank yourself concept, a journey he started while pursuing his MBA in graduate school. Sarry, welcome to the show.
Hi, Sabir. Thank you so much for having me on. I'm glad to be here. I'm a big fan of this show. I'm looking forward to speaking to you in the audience today.
Great. I mean, it's great to have you here. And especially, this is a very interesting topic, because everybody focuses so much on, either you go to the bank and get a loan, or you go and get your VC funding, or your friends and family or angel investors. That's the typical way, right?
Yeah.
So, but before we dive into that, can you tell us about your background and experience in the financial industry?
Yeah, definitely. Thank you for that. So my experience in the financial industry really started, I would say, when I was a senior in high school. I had to take a class called Consumer Economics. We all did it at that time in high school. And it was a very basic, like, financial literacy class. It was how to write a check, what is a mortgage, what is interest, what are credit cards. And I really liked that class because I felt like it was going to be like the most relevant class. Like, everyone would have to take, whether you were going to pursue a degree or a career in finance or not. I felt like everyone is going to somehow be exposed to the banking world and the financial services world. So I really enjoyed that class. I kind of clicked really well with that material. Like, I think I got like the highest grade in that class compared to the other classes I got. So that was something I kind of felt very comfortable with, understanding how money works and the importance of it. So I knew I wanted to do something related to financial services or managing money. I still didn't have a clear vision. So went to college, and then after that I got my MBA. So I went to I'm from Chicago, went to grad school in downtown Chicago, got my MBA. And about halfway through my MBA program, I started working at different companies. I started working at mostly insurance companies. That was my professional background. And again, it wasn't so much about the companies I was working with or the products or the services I was involved in, but really it was about dealing with people and the financial matters and protecting things for people and kind of the psychology of money aspect of it. That was what I was attracted to. That's what I kind of see myself doing. If you ask me, why do I do what I do? And it's really the problem solving part of it, solving problems for people. I think that is a true business form. And that's, from an entrepreneur standpoint, I think that really kind of helps people. It actually gets them to the next level. So that's why I'm doing what I'm doing right now. I started a company called Financial Asset Protection. So we're a full service financial services firm located in Chicago, but we help clients in all 50 states, obviously virtually. Most of our clients are virtual. So do financial services. We also have a podcast called Thinking Like a Bank. And the podcast, as you can imagine, it's how to think like a bank, how to apply the same strategies and principles that banks use that anybody could apply. Again, if you don't have to be in the financial services world or the banking world to apply these principles. So that's kind of my brand that I'm building, the Thinking Like a Bank brand. We have an ebook and the podcast. And yeah, we could definitely dive into that and more into my entrepreneurial journey, or however you want to lead this podcast.
By the way, thank you for reminding me. This is the ebook, Thinking Like a Bank, that's available from Sarry's website, thinkinglikeabank.com. So definitely go and check out the book. I think it's free download, right?
Free, yes, correct. Mm-hmm.
Free to download. So definitely download it. If you're a business owner, you should definitely download this and learn more about it. Thank you for reminding me that. Now, financial industry is such a vast industry, and there are so many different practices. You just mentioned insurance, right?
Yes.
But why, just kind of diving into specifically this new venture that you have now that you have been focused on, what inspired you to specialize in financial, strategies for business owners and real estate investors?
Yeah, I felt like they needed the most attention. So I think that because from a tax planning perspective, there's a lot that you can do as a real estate investor and a business owner. Whereas if you're a W-2 employee, for example, there's still tax planning. You still need a tax professional to help you. But compared that to real estate investing and entrepreneurship, owning a small business, for example, there's a lot more leverage, a lot more things you could do, such as getting deductions and credits and even creating tax-free wealth in the future, especially when you compare that, when you correlate that or connect that with lending. There's a lot of stuff that can go, I guess, a lot of opportunities for business owners and real estate investors. So that's why I wanted to focus in that area. I wanted to kind of niche down to small business owners and real estate investors. And to be more specific, even though I'm talking to most of my clients are business owners, it's still a very personal, one-on-one level. It's not so much of, I have these clients that are companies and I'm referring to them as companies. I actually just refer to them as the first names and last names of the business owners. So it's still technically, it's kind of a hybrid of B2B and B2 consumer, but really it's people to people. I think that's the more relevant. That's the more important path we're trying to take is people to people. So I wanted to focus on the small business owners and real estate investors, especially because the concepts we work with that are mentioned in the Thinking Like a Book ebook are super helpful, especially to business owners. Again, a business owner is going to have more control over the taxes they pay, when they pay those taxes, the expenses they have, when they pay those expenses, getting funding, borrowing money, partnering, joint ventures. There's a lot, millions of different angles a business owner can take. So I think having strategy and having strategies that are applicable to business owners could definitely make or break a business. Like, for sure, it comes down to the who and you're dealing with in business, and also like what the business is doing, aside from just selling the products and services, but also how they manage money, cash flow, expenses, the types of insurance they have, the types of partnership agreements, how they're able to get funding, how they're able to partner with venture capital, angel investors. All these different things have a huge impact on a business. So that's why I wanted to kind of niche down to small business owners and real estate investors.
So let's just dive into traditional versus what you're doing with Bank on Yourself. So can you tell us, like, first go into the traditional, if you're a business owner, how do you see capital, loan, or whatever, right? Traditional channels, and then how does Bank on Yourself is a different model and a different thought process.
Yeah, awesome question. So traditionally, like you're a business owner, you're looking for funding, you would typically go to a bank. They would underwrite your situation, look at your financials, look at your bank statements, your credit score, your experience, and then decide if they want to give you a loan. And then let's just say the loan they give you is like a 10-year, amortized loan. So that means every month you're paying principal and interest on that loan. I guess that's a traditional route. Or another way, maybe another traditional route could be just getting a line of credit where the bank says, here's an open check that you could just, whenever you want to borrow money, you could borrow up to a certain amount and then you can pay it back. And then after like 5 years, you have to pay it down in 5 years. So it's like 5 years in and out, and then 5 years you're paying it back. That's kind of a traditional route. That's something that most people go through already. And there's obviously some problems with that, but the unconventional route we're taking, kind of the Thinking Like a Bank approach, the way we're taking it is you are the banker, you have your own source of funding that you own and control. So unlike the traditional, when you have your own source of financing, you don't have to qualify for your own source of financing. That's a really big thing. And then number two, you don't have to qualify based off of market conditions or the economy. So what this means is, let's say that you have really good credit, you have good income, you have a good business, you have good experience. If the economy is in a downward place, or it's going in a kind of like how it was 6 months ago, or the beginning of 2020 in COVID, a lot of banks are not going to want to give loans at that time. So they're not only underwriting you and your financial situation, they're also looking at the market conditions, because they don't know what's going to happen to your situation or your client situations or your vendors. So it all kind of trickles down together. So when you have the concept of using Thinking Like a Bank in the Thinking Like a Bank ebook, you have your own source of financing that it's not dependent on your credit or your experience, nor is it dependent on the market. And when you have that, you have more leverage. There's more things you could do. Like, you can always tap into funding when others might not be able to. You also don't have to position. You don't have to always think about if a bank will accept your loan or approve your loan or not. So it changes everything at that point. When you change the lending source or the financing source you have, you could acquire more businesses, you can invest in more businesses, you can invest in different types of businesses where you, like, for example, you have your business in which you're actively engaged in. You can go and invest in other business as like a limited partner or a passive partner. Again, this is why I like working with a lot of real estate investors, because a lot of real estate investors are constantly reinvesting their money into different real estate deals. So it's not a limited approach where I have to be able to drive to a property to invest in it. You can invest in properties virtually now, which a lot of people do. A lot of people on our podcast I've interviewed do this very thing where they're general partners of syndication. So it's kind of having that motion, that continuous motion of money. And this is an important kind of banking principle, is you want your money always moving. You don't want to just have it sitting in cash in a checking account or savings account in a bank, because you lose to inflation. You're also losing to opportunity costs. Like, that money could have been moving somewhere else. So you always want your money in motion. So I think that, that's some of the kind of the differences, to answer your question, between traditional lending. You have to rely on a bank and kind of wait for their approval. Whereas ours is you are your own source of financing. You are the banker. And of course, when you have that, you definitely can take over more businesses and do more things in the business and real estate world.
And I think one key thing to remember is it's your money in that bank, and
Yeah.
the bank is using your money to invest in order to get a return from that money while it's sitting there, even though you're not using it. Right? I know that there are banking requirements that they have to have certain amount of liquidity in the bank, a certain amount of cash, right? But the thing is, it's just, let's say you have 50,000 or $10,000 sitting in your checking account. That amount, even though you think it's sitting there, the bank is using it to at least get market returns, so some sort of market returns on that safely.
Yeah, Sabir, yeah, that's a good observation. Good thing to mention is that a lot of people think that when you have a bank, they think that the bank just has, millions or billions of dollars involved,
Sitting in a
and then
safe.
in a safe, and then they just give that money out as loans, and that's not the reality. Think of a bank really as like a conduit or like a bridge. Even think of like a blood bank, right? A blood bank, you go to a blood bank, you give them blood, and then they take that blood and they give that to hospitals and clinics or whatever research purposes or whatever they do with that blood. But they're really kind of just like a middleman between the person giving the blood and the person getting the blood. And same thing with a bank, a money bank, they're just a bridge between people storing money and leaving money there, and then people borrowing money. So it's kind of unfair when you put it that way, where you have money sitting in a bank account, they'll take that money and borrow against that money, usually like 10 times that multiple. And then they're able to loan that out to people who credit cards and student loans and all types of financing. Everybody is involved in the lending business. And, on average, 1/3 of the money we make goes to service debt. So about 33% on average of our money goes to some sort of debt. For a lot of people, it's mortgages, student loans, car notes, credit cards, business loans, things like that. So we're all involved in the banking world. And when people kind of look clear into the banking model, it's kind of unfair. Like, I give them money, they go take that money and make more money with that. Checking accounts probably don't give in most situations don't give any interest at all. It's like a 0% interest. So there's nothing there. And then savings accounts, like as of a couple of years ago, it was like 0.01%, a tenth of a percent, something like that. And then it's gone up with the increase in interest rates, but it hasn't gone up that dramatically. It's gone up to maybe like 1% on your savings account annually. So it's very minimal returns. You'd still lose to inflation. You'd still not be able to retire off of that money or use that as a retirement source or really anything. It's just kind of money sitting there. So that's it's a good thing you mentioned that of how banks store money and how they are able to loan against it. And kind of when you apply the thinking like a bank model, you're able to kind of take that position of the bank where you're storing your own money. It's growing, and then you're able to leverage that money to invest in other businesses at your own convenience. So you are the banker in that situation. You're storing your own capital, managing your own capital, and borrowing against it, and able to finance real estate deals and businesses much faster than other people can.
Yeah, I mean, if you think about just the different types of products as a consumer you buy, right, from a bank, right? And you're literally buying it. Right now, given the interest rates in 2023 is hovering, let's say mortgage is about 7 to 8%. That's how
Yeah.
high it is right now. So if on a savings account, if they're giving you less than a percent, they're lending it back to you. Let's say you're comfortable with that bank, you go back to them to ask for a mortgage. They're
Hmm.
lending part of that mortgage could be coming from the savings you have,
Yeah.
but lending it back to you for between 7 and 8%. If you have a credit card, it could be 15 to 25%. If you have any kind of line of credit or like personal line of credit or something like that, that's between like 10 and 15% or something like
Yeah.
that. So they're making a lot of money from all the deposits that they have, so that they're leveraging it to return it, just to keep it even within the bank, let alone if they are putting it into market returns to get, like, on average anywhere from 12 to 18% on index funds, for example.
Yeah. Yes.
So
Yeah.
let me just jump into, you had a very interesting journey, right? You work for Humana, Blue Cross Blue Shield, Allstate. I think I've been a customer of all of those companies,
Yeah.
over my lifetime. And then how did that experience like inform your like approach to financial planning and the birth of this company that you created?
Yeah, perfect question. Yeah. So as you know, the podcast is called Thinking Like a Bank and the brand. It's also a lot of that, the principles come from thinking like an insurance company. So I got to see how insurance companies think, how they underwrite clients, how they market for new clients. So they're kind of like in this this double, I guess, edged situation where they're constantly looking for new clients, but they're also constantly turning away clients because of underwriting reasons. So they're kind of looking for certain types of behavior, credit scores, things like that. There's an underwriting criteria, and I started to think that way now. And after working for these insurance companies, you start thinking like an insurance company. And the insurance companies and banks are sometimes are the same thing because of how they operate. So they're in the business of managing risk. So like if you go to a bank, for example, and you borrow money, that's that's a risk they have to determine. And then if you go to an insurance company and you want them to insure your house or your car or your life or your health, there's also health is a little bit different, but let's just say everything non-health, there's risk involved, and they have to determine that. So they look at variables to make a recommendation or to accept or to whatever the case is or to deny. So with that, I started to kind of learn how to do my own underwriting. So I have, anytime I invest in a business now or I start a business, or do anything with managing money, I have like a flow now where it's like it has to go through some sort of sequence of flow to see if it's going to be a profitable deal or not. So like, for example, I would have my objective already before even looking at that deal. Like, what do I want to accomplish, assuming there's no deal at all? And then once that deal comes, I match it to that. Does it fit that criteria? What is the expected internal rate of return? What's the expected ROI? How long do I have to wait? What are the risks? What type of industries? And then I go through this whole checklist just to make sure that, and again, there's no guarantee behind this. I could still invest and I could still lose money, but I think that putting it through that sequence slows it down. And definitely in the volume of different investments will, I think, in my opinion, and seeing how insurance companies and banks operate, will yield a return. Because banks and insurance companies, they're not magical organizations, right? They lose money, they make money, but at the same time, they always somehow come out ahead. A lot of insurance companies have been in business for over 160 years. They've been investing, doing all types of business things for over 160 years. And again, they're not magical organizations that have this crystal ball. They're just really good at math and probability and statistics. So like, it's like if somebody came to you, Sabir, and said, I want to borrow $10,000 from you, and let's just say you had $10,000 to loan that person. The question would be, is it better for you to loan that person $10,000 or loan 10 people $1,000 each? And from a banking and insurance perspective, it's better to loan $1,000 to 10 different people because you spread that risk. Let's say 20% of those people default on that loan. You have 80% paying you back now. So this is this is what I've been learning, through the journey of working at insurance companies and kind of applying that to the Thinking Like a Bank podcast, is really how to think about risk differently. Again, I can't guarantee the returns. I can't, but I could definitely have a very high degree of certainty that it's gonna work, right? Like 1 out of 10 will work, 2 out of 10 will work. And even you mentioned venture capital. This is exactly what venture capital firms do, right? When they invest in companies, they're not just investing in one tech startup. they're investing in 10 tech startups, and they assume that maybe 1 or 2 out of those 10 will actually become the next Uber or Facebook or whatever. And then the loss on the other 8 or 9 is still worth it because of that 1 out of 10. Now, it's not exactly 1 out of 10, but that's just the thinking process that goes into it.
Yeah, I mean, if one goes to 1 billion and you invested, let's say, I don't know, $10 million into that company,
Yeah.
goes to 1 billion, that's a good return. And even if you had lent out 200 million to the other companies and it bombed,
Yeah.
net, you made good money out of that, you know.
Exactly.
Well,
Yeah.
there was a on TikTok, I was just going through it. You know, sometimes just sit back and you just go through all of your TikTok rolls. And one of the interesting things that I came across, I don't remember who posted it, but it was one of those to me it was very interesting. It was a insurance hack for life insurance, I think, right?
Yes.
Where you're explicitly asking the insurance company to give you uh, lower value lower value death benefits, but high cash value, so that you're almost treating it like a bank. I don't
Yeah.
know how it works, so I don't know if you have come across it and you understand that, how that tactic works.
Yeah, that's exactly what we're involved in. So it's a lot of people know it as a couple different things. They know it as infinite banking, or in my situation, Bank on Yourself. That's the organization I'm a part of, the Bank on Yourself organization. So what it means is you're using, so to kind of back up for a second, there's a couple different kinds of life insurance. There's what most people know. There's life insurance. It's just life insurance only. You pay for it for a certain period of time. If you pass away within that time frame that you have the policy, your beneficiary, like your spouse or your kids or your family, gets the life insurance from that when you pass away. That's what most people know about life insurance. There's also
And
another
everybody,
kind.
just clarify, let's
Yeah,
clarify that. And everybody goes for, I mean, typically personal finance specialists
yeah,
tell you, advisors tell you, it should be like your mortgage, any outstanding debt and stuff like that, so that your family doesn't feel the strain of you dying. Let's say if you were the primary wage earner. So let's say if you earn 100K a year, right? And then you have a mortgage that's sitting there. So you want to get some sort of a multiple of that, so that the family doesn't feel like, if you were the only wage earner, that they don't feel the strain if you pass away, so that the house is now clear, at least, of mortgage and any kind of other personal debt that you had, or loans or anything like that, so that they don't feel the strain after you die. Typically that's a number. So let's say if it's 100K, you might get a life insurance for 500K or 350K or something
yeah.
like that.
Yeah, I would say if your income is 100,000, I would say 10 to 15 times your annual income. So like 1 million to 1.5 million, because not only do you have like the mortgage, but I don't know that your situation, but what if you have young children, they're still not even in college yet, so then you have to account for college. You also have to account for, like, it might take like the family like 10 to 15 years just to kind of be whole again, because that's what insurance is meant to do. It's meant to make you whole again, financially, of course. So that's kind of, maybe I would say like 10 to 15 times your annual income. But that's a good point. You're right. Like, you want to base it off of your income and then also your liabilities of what you have, so that way you're not leaving your family with all these burdens. But yeah, that's what most people know about life insurance. It's meant to replace your income, or your net worth, your income, and when you pass away. There's also another kind of life insurance, which is more of like a permanent form of life insurance. It has the life insurance, but it also has cash value in it. And over the years, I would say over the last like 20, 30 years, a lot of people in the real estate community and in the private banking community have been using life insurance, like whole life insurance specifically, to lower the death benefit, as you mentioned, as low as possible, but then maximize the cash value in there, so that way they can become their own sources of financing. Now, why would we even do that? Like, where does that even come from? So a couple of things. So number one, the cash inside the policy, it grows guaranteed regardless of market conditions. So that's one very attractive piece. Number two, it's leverageable. There's collateral. You can borrow against it at any point, and when you borrow against it, it keeps growing. So this is where like the banking mindset comes in, is you're always borrowing, but it keeps growing. So you have this effect of growing cash and still using it at the same time, and still have it grow. because it kind of gives you the best of both worlds. And number three, I would say really important, taxes. So usually with life insurance policies, the cash value is the growth of it is tax-free, the loans are tax-free, the withdrawals are tax-free, the life insurance is tax-free. So a big part of your estate planning, your business planning, your financial planning has a lot to do with taxes. So if you can save taxes just on using one vehicle, one financial vehicle, it'll make other parts of your financial or estate planning strategy more efficient. So that's kind of the three. There's more reasons, but that's kind of the top three reasons why people would even think about doing this. Again, it's important when you use this concept to not really look at like the title of it, like cash value whole life insurance. It means nothing, the title, but really the functions, like what can it do? I think that's really important, is if you want to figure out a way to mitigate taxes in the future, or even eliminate taxes in the future, and have your own banking source and your own capital that you can tap into and pay back whenever you want. I think this would be a really good strategy to implement. And definitely you need a lot of learn a lot about this. It's not something that you just hear about one time on a podcast like this and then just go out and buy. It's something that you want to really like absorb and like understand. And even more important than that, like work with a professional who does this like full time. Like they know this very well, this concept. They have a track record of it. They have clients who do this, because there's a lot of like very intricate parts to it, and things that need to be like really understood by the client and the agent.
So let's dive into a successful case study of an entrepreneur or business owner that utilized Bank on Yourself. So let's kind of unpack that through an example.
Yeah, definitely, for sure. So a lot of clients, one of them I was able to kind of prepare for and think about is a client who has a manufacturing company, and what he does is he kind of like manufactures certain parts for cars, and with that he has a lot of expenses, but also there's a lot of time in between earning the money as gross revenue and then having to pay those as expenses. So we did the math and we figured out that in some situations he has like a 6-month gap between the revenue he gets and then the expenses he has. So we figured, what if he funds a few of these whole life policies, high cash value, low death, but low life insurance policies, and is able to add in as much as possible into these policies, and then borrow against those policies, then to use that borrowed money to pay those other expenses he has, and within this is some of the kind of the success things that came out of it. Like, number one, all that money that was going into it is going into a tax-free pool, so it's going to lower taxes in the future. Number two, he can earn interest in the meantime. So 6 months, it's not that much, but over time, like compounded over time, he can definitely grow that money in between just hanging on to it. And this is something that banks do, right? They make money in between just holding transactions in between something. They can make money on that money. And even with insurance companies, like a lot of insurance companies, the way they make money is they collect all their, the premium dollars, most of the premium dollars, and then they invest that in bonds, and they give those out to loans to other companies. And then they have time now to pay let's just say there's a claim. They might estimate that we have a year or 2 years or 20 years or 30 years to pay out these claims. So they can make money with that money in the meantime. So there's multiple ways of making money. So we wanted to apply this for the manufacturing company. We figured it would be a really good tax strategy, as well as a risk mitigation strategy, as well as a financial strategy. So they can make money with that money. They could mitigate risk with that. And then they can also save on taxes. And then, even just as important as all those subjects, they now have their own pool of capital that they could constantly tap into whenever. There's no financial statements needed. There's no credit checks. There's no other collateral except for the policy. That's really important. That's really key. Is when you borrow from an insurance company using your policy as collateral, the only collateral you have is just that policy. They're not going to put your house on there, a lien or second lien or third lien on your house. They're not going to have you put up other collateral, or, it's just the policy itself. So this means that if you never pay back that loan, the way the insurance company gets their money back is through the life insurance. So, like, just to use like a very simple example, let's say somebody has $100,000 in cash value and $1 million in life insurance, and then they borrow $50,000 and they never pay that loan back. Let's just say 10 years later, the life insurance grew now. let's just say that life insurance now is like $1.5 million, and that person passes away, the insurance company would write a check for 1.5 million minus the
The
outstanding,
50,000.
yeah, 50,000, and then there's going to be interest due on that. So minus the interest on that, let's just say $70,000 with the interest. So they take 1.5 million minus 70,000. So because the life insurance, even when we structure the policies to have low life insurance, the life insurance is still much greater than the cash value. So when you have it that way, even with the outstanding loans, even with the interest you have to pay on those outstanding loans to the insurance company, even with that, you still come out, your family still comes out ahead when you pass away, like many years later, because the life insurance is growing at a far greater multiple than the cash value. So that's really important when it comes to running a business, because when you borrow money from a bank for your business, there's a lot of collateral that goes into it, whether it's a personally guaranteed collateral, personal guarantee, or you're putting up your assets or real estate, your personal real estate, your business real estate. There has to be collateral, even if it's an unsecured loan. Your collateral is your personal guarantee, your personal credit. So it has to be there for the banks, and that can be very problematic for people, because what if your business goes down? You still have to pay those loans. It's like the loan isn't tied to the business performance. If the performance of the business goes down, the loan is technically going to keep going up because time is continuing to go. So you still owe on that. So I think it's very important to think about these things and have hedges against these types of unknown risks. We're not guaranteeing you'll be financially successful, but we're mitigating every risk possible.
So one scenario I was thinking about was, let's say if you're a business owner, you have, I mean, this is not a startup. Let's say it's a small business or maybe even family-owned business. You have some key people, key officers like your COO, CMO, CTO, and so on and so forth. Can businesses utilize the same strategy to get like a whole life insurance on their employees, so that, just God forbid, if something happens to that person while they were the CMO of the organization and they are a key member of the team, that because the person passing away is going to be also a loss to the business too, not just on a personal level but also on a business level. Do businesses utilize that also to have that sort of an insurance policy there, that they'll pay into it, and then it's going to have a certain cash value to it, but it benefits the company, not necessarily personally that person's family, because of the loss of the person?
Yeah, awesome question. They definitely do. So there's something called BOLI and COLI, so bank-owned life insurance and corporate-owned life insurance. So a lot of banks use life insurance for their employee benefits. So let's just, like you said, they have the CFO, CMO, CTO. They have these important executives that they need to keep and retain. So what they could do is, like, the bank could get a life insurance policy on all of those individuals, and then the bank is the beneficiary. So if something were to happen to those executives, the life insurance would go to the bank. So there would be like a windfall for the bank, a tax-free windfall for the bank. Plus, they can use those proceeds to offset other expenses they have. And then plus, there's even some situations where you could have an arrangement with an employee where it's like, if you last with us for 10 or 20 years, we'll take this policy and then convert it from our company owned policy to your own policy. Now, then
Oh, interesting.
you change the beneficiary to your spouse or your kids, your family, and then you take the cash value with you. Now you have control of it. You have control over that cash value. So it's like a retirement plan. Again, there's a lot of tax benefits when companies do this. So yeah, definitely 100% companies do this, either BOLI, bank-owned life insurance, or COLI, corporate-owned life insurance. A lot of companies, even they do this for their executives to retain them, also to mitigate risk, because what if you have somebody a key employee, somebody who's essential in your business, and without them, it would take you, I mean, think about how long would it take you to replace a CEO or a CFO who's specialized in your company? It might take years to
And
replace
your
that person.
industry, yeah,
Yeah, in your industry,
specifically.
exactly. So that money, the life insurance money that the company gets, could be used to make the company whole again. And as far as replacing that key employee, and then the the retention strategy is really important, because let's say you're the employee of a company, you're getting paid, let's just say you're a high paid employee, you're getting paid like $200,000 a year, and then you're with the company for a year, and then a recruiter on LinkedIn just messages you saying, hey, we can offer you 250 for that same role that you have right now. What's to stop that employee from saying, oh, 50,000 extra? I could just go over there. That'll pretty much cover my tax liability, just going there, and I get to keep, the rest of it. If they have this key man policy that's going to be handed over to them, 10 years later or whatever the case might be, there's more skin in the game now for the employee. There's more to look forward. They might have that plus their 401k, plus a company IRA, plus like some sort of pension, So there's more things to look forward to with staying with that company. $50,000 increase just a year later, it's probably not that going to be that attractive for that person. I don't know what the financial situation would be, but a lot of people, I think, from a psychology standpoint or retention standpoint, are going to be attracted to something that's far more long term and more sustainable.
So as a business owner, because the show actually focuses on the entrepreneurs and business owners, like let's say if I'm, let's use me as an example, right?
Yeah.
I own this business. I provide these services to my clients and stuff like that. I'm a key employee of my own company,
Yeah.
right? For that insurance policy, it makes sense for the company to take out a insurance policy on me as a key employee, and then it could be funded as a business expense to the company, like the Coley example that you
Yes.
mentioned earlier. And then with some sort of a turnover that after a certain period of time, if I want to switch that over to on a personal level and reward that to myself, I would be able to, as the owner, I could bring it over to my personal life than my business life.
Correct. Exactly. You're right. You're correct. Yeah, you can always, there's kind of three parts of the policy. There's the owner of the policy, there's the beneficiary, the person who gets the life insurance, and then the insured. So like the person who's insured, the insured always has to be a person, obviously. The beneficiary and the owner could be a company, an entity. It could be an LLC, it could be a not-for-profit organization. It could be really any entity for that matter. And then both the owner and the beneficiary can change anytime. The insured really is kind of set. If you change that insured, it's a different policy at that point. But the owner, the beneficiary, can change. And again, this is what a lot of companies do. They have it in the meantime where they're the owners, they're the beneficiaries of that policy, and then until the employee or the business owner reaches, or let's say the employee reaches. If you're the business owner yourself and you own, let's just say you are the business owner, you're the sole owner of your company, then I think it would probably make sense, just with limited information, I think it would make sense to just have the business owner have personal policies where he or she owns the policies, their wife and or spouse and children are beneficiaries on those policies. Because and I would recommend it that way, because if it's a sole proprietorship or like a single member LLC or a C corp that's just owned by one person, and then that company owns the life insurance policy and the person passes away, then the proceeds of the life insurance, the death benefit, just go to this entity that was owned by that person. So it might kind of like defeat the purpose. Like, why even have that in this situation? When the company is a beneficiary, it makes sense when you have other partners or the employees are the insured, and then the death benefit is going to go back to the company. So just some little nuances. I think if it's a small business owner, individual with no other partners, I think just owning the policies personally is probably going to be more advantageous to that person, more relevant to them. But definitely if they have partners and other employees and stuff like that, I think having to go back to the company could be a strategy. And this is where like financial planning comes in and estate planning, because a lot of times it could be both. Like if you have the company with other executives and other partners, it could be definitely a reason to have multiple policies, where some of the policies go to the company, are owned by the company for tax purposes and for the death benefit to go back to the company, and then personally owned. So that way it's outside of the business entity and it's in your personal name and it goes to your family. So I guess both strategies work. It depends on more details to know the client situation. It's like there's like a diagnosis phase in financial planning where you have to understand the client situation and then make these recommendations. And then these recommendations are intended to change over time.
I mean, there are so many, by the way, there are so many other alternatives nowadays, right? We're living in, I think, in the age of many, many choices,
Yeah.
Sometimes it's good, sometimes it's not so good, But given the choices of like finances, there are so many. It's not just a bank or the insurance companies. You have things like crowdfunding and
Yep.
peer-to-peer lending. How does that play into an entrepreneur's decision or business owner's decision as part of their kind of the financial strategy mix?
Yeah, absolutely. Yeah. There's a lot of choices as you mentioned. It can be good, it can be bad, right? It can be bad because it can lead to, what is it, paralysis analysis, analysis
Yeah.
paralysis. Yeah, so there's too many different options. I think that, and just to be clear, Sabir, your question is how can those other types of capital raising, like crowdfunding, angel
Yeah, the
investing,
alternative financing methods, not just your bank or insurance
oh,
or
gotcha.
VCs or angel investors, but you have also things like crowdfunding and peer-to-peer, like Prosper.com and
Yeah, yeah.
Kickstarter, and there are so many other types of ways of funding your company.
100%. Yeah. So I think all this changed really in like 2017 after the Jobs Act. So like when it comes to like raising capital, really that was kind of exclusive to like large companies. Technically speaking, only large company. I mean, if you look at the sequence of the laws, it's like only publicly traded companies can raise capital except in these situations like Regulation D, 506B, 506C, and so on. And then 2017 was a game changer for a lot of, especially small business owners, because now they could do something like Reg CF funds or Reg A funds. So pretty much, let's just say you needed to raise like $1 million. You can go to 1,000 people and raise $1,000 from 1,000 people. And that's really, I guess, significant because if you look at it from a population standpoint, most people fit into that category. From the investor standpoint, like most people, just broad economics, have only a few $1,000s to invest. Again, this is broad economics. Most people don't have like hedge funds or mutual funds where they can invest that much. So it's more relevant to a larger group of people that are going to be able to invest a few $1,000s into businesses. And then vice versa, most businesses are going to need like, there's a range. Most businesses are not looking for billions of dollars. They're only looking for a few. Again, I don't want to generalize and say most businesses are looking for a few $1,000,000, but when the Jobs Act happened, it helped kind of both sides of people looking to deploy money and then people looking to get money. And when you have it that way, when you have the crowdfunding and you're able to raise capital from a lot of people, it helps the business owner raise money without having to go through the publicly, the whole becoming a public corporation and the fees with that and the rigorous parts. It's still rigorous from the Reg CF standpoint. Like that's still a rigorous process. You still need an attorney, you still need an accountant, you still need all that stuff. But really, I think it's incredible because it gives more competition to the small business owners. Again, the small investors and the small business owners. It gives them more kind of a say into the economy. So I'm definitely for. I've invested into Reg A funds and kind of smaller deals. I've also invested into the Reg D funds, like the real estate syndications. And I think that, again, I don't want to be biased towards the stock market, but I think there's a lot more you can do. Just my opinion. Don't take this as financial advice. I think there's a lot more you could do in the private world of investments versus just investing in, publicly traded corporations using, stocks and things like that. So there's definitely a lot more opportunities when you have private companies, a lot less money you can actually put into it. And I think the multiple is more. If you're listening to this and you're wondering, like, should I invest in stocks or should I invest in a privately held company? One big difference between those two is put risk aside for now, but it's liquidity. So if you put money into a private real estate deal or a Reg A or Reg CF fund or something like that, chances are it's not going to be as liquid. Like you're going to have to wait. They'll tell you that from the beginning. Like it might be a 5-year holding period. It might be a 3-year holding period where you're just putting money in and it's going to accumulate. It might have cash flow, like you might get dividends or something back from that in the meantime. Whereas when you invest in a publicly traded company, you could put money in today and then tomorrow take that money out. So it's far more liquidity. So you want to make sure that you're not in a situation where you're putting in all your emergency funds into businesses. You want to have like a healthy balance, only allocate a certain amount that's going to go to your emergency funds and then some that's going to go through investments, and then account that you might need a few years. If they tell you 5 years, I would account for 5 years of holding that money. So you're not put in a situation where you have to try to withdraw that money. You probably won't be able to, or there'll be penalties or things like that, just to deter people from wanting to take their money out earlier. I personally think that is a good thing to do if you have all these investors pooling their capital together and all their money is locked together. Because one of the ways that stocks go down in value is where people are constantly selling those stocks. That drops the value down. So if you have a whole bunch of people that are nervous and then you start selling that stock and it drives the value down, what if the same thing happened with the privately held businesses and all the investors were like, I want my money back? One by one, it's going to collapse the business. So if you have the money tied together for a certain period of time, I think personally that it increases the chances of success for that business, because it's not like you can take your money out at any point. So just some small, I guess, optimistic ways of looking at tying up capital in a privately held business.
So since we're talking about markets, and markets have been in a turmoil recently, right? And there has been quite a lot of collapse. When I say market, I don't mean just stock market, but the cryptos and the blockchains and everything.
Yeah.
It has been falling. So when you are advising your clients, and especially the entrepreneur clients, some folks, some business owners, what they do is when they have access to a lot of capital, I'm just
Yeah.
talking about the opposite problem now, right?
Yeah.
Not that you don't have money, you have too much money, too much capital sitting on the sideline. You don't have that many capital projects. You can only fund so many of them internally to grow your buying a machine, increasing your employee count or whatever.
Yeah.
But you still have money left, right? How do you handle, given the fact that there are so much market turmoil, and what happens is you hear things like, Elon Musk took, this happened a couple of years ago, right? He took the cash position of Tesla and put it into, I don't know what he bought. It was something in crypto. I don't know if it was blockchain, or it was Bitcoin or Ethereum or something like that. And then it had its run up, great for him and for Tesla. And then he pulled out so much of it. I don't know if he pulled out everything or he pulled out most of it, but he more than tripled his, cash position. So he started with having too much money, and then he had way too much money. But the thing is, that ended up collapsing a lot of the coins and stuff like that. So bad for the markets, good for him, right? But when you think about these kind of market conditions, and it is, you have that roller coaster. That's fact of life with markets, regardless of what kind of market you're in, including interest rates and bonds and stuff like that. Even the things that you think are secure are not really that much secure. So how does that play, like the current market conditions play into your financial strategies when it comes to like business owners? Because sometimes their needs, in that example, their needs may be already met and they have too much money, or their needs are not met and they are looking for money. And you mentioned liquidity. So how does that play into the market conditions, play into your financial strategies for those business owners?
Yeah, absolutely. Awesome question. So you're so right. It's almost like you've been, researching what I've been talking about on other podcasts. So a lot of companies, they reach this good problem point where they have extra money, and to reinvest that extra money back into your own business might not always be suitable. Like, what if your business is only a small business with like 10 employees and you have all this extra cash to put that money back into your own business? It might not make sense because the business is already doing really well and producing cash flow. So then it brings us to the next question, like, where does that capital go? Does it go to a bank account and sit there and not earn any interest? No, I would think like a bank and think like an insurance company and have that money deployed into other types of businesses, especially businesses that are not correlated with your business, so your industry. So like different kinds of businesses. This way, if something does happen to your business, you have other investments in other types of businesses that you could potentially hedge against, or still make money even when the industry you're in goes down. So that's one thing.
So those are like, so sorry, just to be specific there, cyclical businesses, right? So if you have a certain type of a business you're in, there are business cycles within your industry. You know that every summer for 2 months your business is dead, right?
Yeah.
Because you're snow removal business and it's summer. Don't invest in like equipment manufacturers that sell snow equipment, snow related equipment, or whatever.
Beautifully said. Yeah, exactly. Yeah, if it's like snow, I would invest in like a
Landscaping companies.
Landscaping, exactly, like the opposite of it. Absolutely, for sure. And I would also look at like cash flow. I would look at from the investment you're making, like, are you going to get cash flow from that? Because what if you can take from your active business that you're working and you're putting in hours, and every year you can just take money and put it into different kinds of businesses that can provide cash flow, and then to the point where you now have multiple sources of cash flow, and then you can even automate your active business so that way it becomes like a passive investment, and now you have all this passive income. This is something that most business owners don't do, and the reason why they don't is because their active business that they own, they assume that that's going to be their primary source of retirement. Because for a lot of people, for a lot of business owners, their business is their biggest and most important asset in their portfolio. So it would be reasonable to think that that asset you have is going to be the number one retirement source. But then as they work in their business for like 30 years, they're the face of the company. It's not really a sellable company because they're the only face of the company. And again, I interviewed somebody on my podcast who's an exit factor specialist, somebody who just specializes in exiting businesses. And she mentioned like it's like 85 to 90% of businesses are not equipped for exiting because of the owner being directly involved, because of the attachment with clients, because of the attachment with vendors. Like there's a lot of small kind of human emotional aspects in business. That is entirely business. But as far as the factors within it that can actually hinder selling a business. So when you want to sell your business, you have to go in and kind of alternate those things to get the business prepared. So I would have multiple sources of income that are not just relying on just your own business only. I don't know. Does that answer the question, or you want me to keep going?
Yeah, I mean, there's an example. I mean, if you think about an example, let's say it's Chef Gordon Ramsay, right? As an example, he's not your client. I don't think he is, but so Chef Gordon, maybe in future. So Chef Gordon Ramsay opens up for the first time. Let's say he's not the TV celebrity he is right now, but he opens up a restaurant, and that's a restaurant in Midtown is super successful called the London, right?
Yeah.
Now everybody associates the London. I think he owns the London, I believe. So the London. Now he wants to sell that in this fictional story, right? He wants to sell that restaurant. That actually, if he's too much associated with that restaurant and not, he doesn't have sous chefs and other chefs and stuff. All he's doing is just providing his celebrity to it. Then there's a possibility that it's easy to sell that restaurant. Or this happens to a lot of restaurant owners. They become the face and they become the icon for that restaurant. So when time comes for them to retire or they want to move on, it's hard for them to sell that restaurant as is, right? But with the same name, like the London or something like that, because everybody knows the London to be Chef X, and if that Chef X is no longer there, is it going to have the same level of revenue that it gets on a weekly basis where it's sold out for months and months and months?
Yeah, absolutely. Because to add on to that, it's a good observation, good question. So when you have, for example, Gordon Ramsay in the London, let's just say, I've never been in the London restaurant, but let's just say when you walk in there, he has pictures of himself. The pictures of himself and his name and his identity being matched at that company is a replicatable thing. Like you can have his name inside the business. He could license his name and his pictures or whatever to the new owners, and then now the new owner, it's still known as Gordon Ramsay's restaurant, but he's not physically there. So this is the importance of brand.
By the way, you're about to have a little bit of a slip up, and I really like that guy too, Dave Ramsey.
Oh, yeah. I just heard the last name Ramsey, and I connected them, But so his brand is replicatable. And correct me if I'm wrong, but that's what makes a brand truly like unstoppable. Like for example, let's just say Coca-Cola. Does it matter who owns Coca-Cola? Like who's the CEO of it? I couldn't even tell you who the CEO of Coca-Cola is, So I think that's the power of like branding and having that in your business. It doesn't really matter if you're there or not. If you can transcend your identity and your thoughts into that brand, then that brand can last for 1,000 years, and be sold and, become an investment vehicle for new buyers. But yeah, definitely, I would definitely, in that situation with Gordon Ramsay, for sure agree. And then also with the standpoint of small businesses, this happens mostly on the small business level, where it's not really a replicatable business because of the constant engagement of that business owner in that business.
Yep. So I think I'm in trouble with Growth by Sabir because it's everything. It's my model. That's how I grow my clients'
Yeah.
businesses. So I'm in trouble. Until I
Well,
turn Sabir into a framework, like Sabir is a brand name now.
yeah,
I'm going to turn it into Sabir as the framework.
yeah,
So then
yeah,
then it's not the person anymore. That might be
yeah.
my trick.
Or
Yeah.
like a marketing or branding concept called the Sabir marketing concept.
Yeah,
That
definitely. I'll
yeah.
work on that. So, Sari, what is and thank you, by the way, for sharing so much intricate details and all these examples and stuff like that. And I hope that entrepreneurs and other business owners that are watching this, they're getting a ton of value. What is given that this amazing journey you've had, and so you're so rich with so much knowledge here in this field of alternative kind of financing and banking, what is your number one $100,000 expert insight into banking on yourself strategy for business owners and real estate investors?
Yeah, number one, I would say is that we are, and I mentioned this earlier in the podcast, like we're already in the banking industry. So this isn't something like it's going to take you away from something you're already doing. Like you're already involved in the banking industry. Like every business, every person is a bank client, a borrower, some sort of affiliated in the banking industry somehow, some way. So if you can kind of churn the tables where you are your own bank now, you're your own source of financing, of lending, it changes everything at that point because you no longer have to abide by banks, underwriting. You can constantly invest in your own business as well as mentioned other businesses, which is really important to do that. Kind of not have to, like when the economy, because a lot of people too I've noticed where they live and die by the stock market. If the stock market is good, then life is good. If the stock market is down, then their life is down. It's kind of like I don't know what kind of mentality it is from a psychology standpoint, but it's kind of like a reliance on external factors, reliance on the economy, on the government. And really, I've probably read, I don't know, maybe 100 or maybe at least 100 business books about the psychology of business and money. And almost every single one of those books talk about, this internal realization where everything comes from within you. Like the way you perceive the world is because of the way you see the world, and you look at people who are very wealthy, like they've always been wealthy regardless of how the economy was. And then even take it a step further where, let's just say, hypothetically speaking, I don't think this will happen for probably another 100 years. If it does happen, the United States becomes like a third world country. The top 1% of people in the United States would still be the top 1% of people somewhere else. Another country, they would.
Yeah, you
So
can take
that's
away all of their money. You
yeah,
can take all of their money, they'll make it back.
exactly, because there's the internal effects of it, of how they see. So that's kind of like how I would leave this, is really kind of create your own destiny where it doesn't matter what the government says or what Wall Street says or what banks are financing or not. And I grew up in the 2008 era. In 2008, that's when I was getting into the real world. So it was kind of a pessimistic approach to that. I thought everybody was broke. I thought, but really that was just probably my paradigm of where I was raised, where I came from, and my surrounding. So I think that having your own internal vision and control is really what matters, not what's going on the outside.
Definitely. I mean, it starts within you,
Yeah,
right?
yeah,
So the more you can do with that and work on yourself, the better it is. And especially with this topic, thank you for this amazing content that we just
yeah,
shared with entrepreneurs and business owners. I think it gives them another kind of option, at least to explore. And definitely, what I would recommend is if your business needs that sort of financing or thinking about financing differently, definitely reach out to Sarry at thinkinglikeabank.com and definitely check out the ebook. That's a free ebook that you can
yes.
download and learn more about that. So and thank again, Sarry, thank you for being on the show.
Thank you, Sabir.
And thank you for audience for again tuning in and giving us 60 minutes of your life. And we try to keep on delivering amazing guests as Sarah is here to and exploring topics that can enhance our business and grow our business and put it on a successful, profitable trajectory. Thank you again for tuning in.
Thank you.